Alrighty. Hey, everybody. And I got a hot show for you today. Lots of stuff going on in the real estate market. Lots of stuff going on in the economy for sure. And so today I want to talk to you about how the media is lying to you, to us, about the real estate market and about the economy, and how it's really could be causing everybody to make some really bad financial decisions. I'm not here to tell you what decisions to make, but I do want to show you the data so you're operating with facts and not opinion and not fiction. And so you can make those important decisions on your own. Make sense? Cool. All right. So we're going to talk about foreclosures. We're going to talk about the housing inventory. What else are we talking about? We're talking about inflation, of course. We're talking about, is there going to be a market crash? Is this a good time to be in real estate? Should you keep buying? Should you sit on the sidelines and wait for the crash or wait for a dip? So we're going to talk about that, and then I'm going to talk about the deals. Where are they going? Where should you be looking for them, and where you should focus? And what's the next thing? Oh, and then just recently, so much has happened. I planned this 24 hours ago, and so much has happened in between then and now that I really want to share with you as far as my own real estate business and the business of my REI ACE private clients. Some really exciting things there. I'm going to share with you a brand new strategy or a brand new approach to where it's an old tactic I had. I don't know if tactic is the right word, but an old piece of advice that I used to give to home sellers when I was a real estate agent. This was 14, 15 years ago. And then combine that with the pitch that I have to get seller financing accepted, and combine those two things. And I used those twice this week, and both times they turned into a seller finance deal. So I'm going to share that with you so you can copy that and take that out in your own market. All right. So let's get started. I'm going to share my screen here real quickly. I think I have to do this. Hold on, or else I'm going to get this infinite thing there. Okay, cool. All right. So let's close that window, and I'm going to close that window. Close that window. We're just going to start with a headline that could be scaring a lot of people here. Hey, James, good to see you. All right, here we go. Sharing my screen. I'm going to take this window, and we're going to go right here. All right, perfect. Okay, so this right here says foreclosures are up 700%. And I've heard people quote 800%. And this could be a scary thing, right? Here at the Motley Fool is this a red flag for the housing market? And that could have somebody thinking like, oh gosh, I'm not going to buy a house now because prices are about to plummet because everyone's going into foreclosure. And though foreclosures are up 700%, that may be factual, but there's a big distinction between what's factual and what's actual. And let me show you what I mean. It is, if we looked at this right here, this is from Adam Data. And U.S. foreclosure activity sets post-pandemic highs in first quarter. So there's another thing. Oh my gosh, it's setting a new high is what most people will read. But you have to understand two things. Actually, maybe three things. One, there's two parts to foreclosures. There's foreclosure starts, and then there's foreclosure completions. So two totally different things. So a foreclosure start is typically a notice of default. Someone missed a payment, or two or three, depending on when the bank actually files that. So if we look at this chart right here, foreclosure starts. They may be up 700%, but if you come down here, like here's our little spike right there, right? And so that's, if this line across here represents 100,000 foreclosure starts, we're basically right at 50,000. And if we look at that historically, that's still half of what we were at, a little more than half, at this basically an all-time low just before the pandemic hit. So we're just about half of that. So actually, it's very low. Factually, yes, it might be up 700% from 2021, first quarter, 2021, first quarter, or second quarter, 2021. So yeah, it's up 700%, but that's factual. What's actual, we're down 40% from our all-time lows pre-pandemic. So you can look at that two different ways. So there's a book out there, and I read it before a long, long time ago. Didn't get too deep into it. The cover kind of said it all, but it says how to lie with statistics. So anytime you see a news source sharing you some dramatic data and they're using a statistic, you got to stop and question it. What is that, or not statistic, a percentage? So once you see that percentage, it's up 700%, which sounds like a giant number. But if it's 700% from 1,000, that's 7,000. But if it's up 700% from 100,000, that's 700,000, right? So the difference between 7,000 and 700,000, that's a huge gap. But the difference between 700%, 700% is the same. It sounds really dramatic. So keep that in mind. When you're hearing the percentages, question what that's a percentage of. So here's our foreclosure start. So this is what people that have missed a payment. But if we go down to see the foreclosure completions right here, so if our median line here is 50,000, and here we are, the foreclosure completions is right about, what's that? Maybe 10,000. So we've got 50,000 starts, but only 10,000 of those went to completion. Now, granted, you have to have the starts. That's going to take some time before you can actually have the completion. So seeing the starts, that's a good precursor. It could be a hint of what's to come, and it most likely is. But is it really some sort of tragedy, or some sort of crisis going to happen? Because even if we look at the completions right here, we're still less than half of the completions just before the pandemic. See that? So percentage-wise, what's factual is high. Historically, actual, it's really, really low. And then we look at this. So here's the average days to complete foreclosure. So it's average days to complete foreclosure is 900 or so days. So it's almost, what's that? A little less than 3 years, 2.5 years, I guess. So if we did that up here, so if we have all of these starts, it's going to take 2.5 years for that to even hit the market. So are we going to see this giant flood of foreclosures hitting the market? Probably not. And so here's the second reason, and I would say that historically, but let's look at what's actually happening right now. If we look at home equity skyrocketed during the first quarter of 2022. And so if we come over here to look at, I think I had a chart here for it. I pulled a bunch of pages up here for you. So here's the home equity this is June 2020, right? Here's 2020, and then here we are in 2022. So extraordinary wealth created by the pandemic housing market. And our headline over here was, home equity skyrocketed during the first quarter. So people that are missing payments, they just don't, and they have a bunch of equity. They just don't call the bank and say, sorry, I can't make any more payments. Come take my house back. They're either going to likely sell or potentially refinance because they are rich with equity. So the foreclosure thing, yes, they may come. Times are getting rough, and I don't have a crystal ball. I don't know how far this is going to go. It looks like it's not as of this morning with the inflation rates going up another percent to 9.1. It's not getting better. So we're certainly headed in the wrong direction, but nothing has really happened yet. All right. So let's look at the next one we got here. All right. Housing shortage starts easing as listings surge in June. Right. Look at that word, surge. So housing inventory in June was 19% higher than a year ago, but overall inventory is still about half of pre-COVID levels. So that 19% sounds like a big increase over a year, but 19% of what? We're talking about 19% of essentially an all-time low, right? And then, so if we look at that, let's look what our active listing count is. So this represents a full calendar year by month because active listings will ebb and flow seasonally. So up here at the top, this blue line was 2017. That's kind of where that market was. And then 2018, we dipped a little bit, but it kind of followed the same pattern. And then 2019, pretty much the same thing. Not too much difference between 2017 and 2019. Then the pandemic hit, and we saw the listing count drop, right? So there's during the pandemic, so people stopped selling their houses. And 2021 started to ease up a little bit, but still really, really low, historically speaking. And here we are in 2022 at our all-time low, and we are edging up, right? I wouldn't know if it's a surge. I mean, this could be a surge, but it's not up that much as far as quantity goes. And it's going right in alignment with the season. So this will probably continue to go up for the next few months. And then it'll probably dip just like it always has seasonally. So be careful what they're saying out there with regard to a surge. This is definitely a surge from April here, because that's kind of maybe the most upward line that we got. But over here was nice and flat, but we still had a lot more of the number. So factually, we have surged. Actually, we are still very, very low. So this is what we had up here at this time. Typically is about 120 to 130, or yeah, 1.3 million to 1.2 million. And here we are at less than a million. All right, so next one. What's this one? Housing shortage starts easing as listings surge in June. Okay, I think I already had this pulled out twice. Okay, so let's move on to this one. So housing market falling like a brick. I like this one. It's falling like a brick. Let's go look at what's causing it to fall like a brick. Oh, I could just come back to this one right here. If the housing market is falling like a brick, well, the median listing price in June hit another record high of $450,000, right? Not really falling like a brick. But that's how they describe it to us. That gets us all riled up. It gets into our mindset. It gets into our thinking and impacts our actions. And it could cause us to pull back when we might be wanting to move forward and vice versa. So here we got Redfin stock tumbles after it says housing market deals are falling through at the fastest rate in 2 years. So what this is saying is the pending sales, buyers that are in contract are canceling contracts at the fastest rate in 2 years. So this sounds like they're falling through at the fastest rate, but just at the fastest rate in the last 2 years when we've had an amazing market. So it doesn't take much for it doesn't take too many cancellations for it to be the fastest rate out of the last 2 years. And so then here's the other one. Home sales face highest cancellation rate since pandemic start. Asking rents show smallest increase. So the asking rents. So they're saying, they're telling you that the rents aren't increasing that much. So they're trying to paint this picture of how we have this highest cancellation rate and the asking rents show the smallest. But this is the asking rents. It's not the actual rents, which I'll show you here in a second. But if I scroll down here, these are the deals in the housing market are falling through at the fastest clip since 2020. So this is just right here to here. So this is pretty much a flat line. We haven't, I mean, obviously this was the pandemic, so a lot of stuff got canceled. This would be a little bit higher than usual since 2017, but we're not seeing any real big jump here. But then what we're also looking at, this is not the number of cancellations. Again, pay attention when you see percentages. This is the percentage of pending home sales are being canceled. But we're at a slowing activity of pending home sales. So this 14% is of a smaller number. So if we were 14% of all-time home sales, then that would be a big, significant number. So again, right here where we are factual, 14.9% cancellation, but it's what's at 14.9% cancellation of a historically low pending home sale number. But here's why it's happening. And I'm not saying to ignore this. I'm not saying this isn't important. I'm not saying that, just, close your eyes and just move forward as usual. You definitely want to pay attention to this. And it's good because this is the trend. This is what it's pointing to, but it's a very brief trend. I mean, this is all within just the last few weeks where we're actually seeing this happen. So let's look at this though. This is why. Rising interest rates are crushing. I love how they say crushing, right? We just thought, how can we have an all-time high in prices and these mortgage rates are crushing the U.S. housing market? But let's look at this as to why they are being crushed. Okay, so, or what's actually happening. I'm going to switch over here. Hopefully I can do this rather easily here. Switch my camera. That's disable camera. We don't want to do that. On the settings, and then we'll hit the new video camera. I'm going to go to my desktop camera here. Oh, not that one. Here we go. Hopefully this works. Perfect. All right. So here's my desktop camera. This is what's happening right now. Why the cancellation. So if we have this house here, and say this house is $400,000, right? And so back in January of 2022, you would have you'd pay $400,000, you would have borrowed $300,000 from the bank. So put 20% down, right? What was this? 25%. We'll just say it's 300% or 300,000. We'd have borrowed this money at 3.5%. That's what the mortgage rates were, which would equate to a mortgage rate of $306 or $1,306 per month to buy this house is what your payment would have been. Now we'll come here today in June 2022, and just in 6 months, we've had a 6% increase in price, 6% from here to here. Okay, and so what that puts us at is $339,000 is what we're paying for the exact same house that we were paying for in January. But here's the kicker: now the rate's 5.25%. Okay, and so we take this, and what's our payment there? Now it's $1,879 a month. So in just 6 months for the exact same house, even though the prices went up just 6%, which is still a lot for 6 months, but our affordability went way down because we're paying basically almost $600 more for the house right now. And this is what's happening to people while they're in the middle of escrow, and this is why they're canceling. Okay, so this is why they're canceling. So that's what's actually happening right now. And so the sales may slow down in activity. Let me come back to the video here. And so although it's hurting some people in the market, it's not crushing the market because the prices couldn't go up if it was being crushed, right? So let me come back over here to where was I there? There's that one. And then what's this data? Oh, this is the pending home sales index. So pretty much pending home sales are pretty flat. What was this data piece I wanted to get here? Oh, so these people that are falling out of the market and they're not buying a house, where are they going to live? They got to go rent a house, right? And that's what we're seeing right now. So this is as of June 2022. So the national average rent price trends for a one bedroom is up 25% year over year. So the home prices have increased, I believe it's 15% year over year, 6% just in the last 6 months. But the rent year over year is up 25% for a one bedroom, up 26% for a two bedroom. Now, this is a rare moment in history where the rents are rising faster than the housing prices. And there's a reason for this. And I'll switch now over to a different screen I can share with you. Okay, I'm going to stop this one, and then I'm going to come over and share this one. Oops, let's see, share my screen, come over to this window. And I just did this presentation in Seattle here this last weekend with a bunch of aspiring real estate investors. And let me come up over here. Hey, big boy, I'm on the line real quick, and I'll help you in a sec, okay? All right. It's take your son to work today. Take your son to work day. So there's something I want to point out here, and it really comes down to supply and demand. So here's another way how you're hearing people or the news talk or lie with their percentage of their statistics, because we're hearing that the growth of the population is decreasing and it's slowing down. That's what we keep hearing. From a percentage of growth, that's this orange line that you see here going down the middle. Definitely the percentage of growth is slowing, but this blue line represents the actual population. So factually, we are decreasing in growth rate. But actually, we are increasing in population. So we've got a lot of people right now. We've got more people than housing. You've probably heard me say that before if you've been around for a little while. But here's what's significant about our population is if we look right here, here's our population broken down by age. And so if you look right here at the peak, right here. I forget my stats here. So right here at the peak, we're at the age of 29 years old. 29 years old right there. And so if we come back, just go before 2 years, so there's a big chunk of the population that's coming right through. The average age of the home buyer, the average age of the first-time home buyer is 31 years old. And the peak of our population is 29. So as this little peak ages and becomes 31 years old, over the next 24 months, we're going to have more demand for housing than we have ever seen before in the history of the country. There are more people already walking the earth. They're already here, and they're looking for homes. They're going to need shelter. And if the monetary policy at the time being is pushing them out of the sales market, there's a reason that we're seeing this big increase in the rental market. So the question you want to ask yourself is how do I win from this information? Well, if the housing is kind of decreasing a little bit in the affordability and they have to live somewhere and they got to rent somewhere, you want them renting your property, don't you? You want to be investing in income property. That's how I see it. That's how I interpret this information. So there's that. And then what's the other part of this information I want to share with you real quickly? So there's the demand. We know the demand is there, but this is an incomplete calculation without the supply, right? So if we come up here and we saw the supply, here was our inventory. I showed you that chart already. This was from April. I showed you the recent one of June. So we've increased up a little bit, but historically speaking, we're still really low. But this is an issue. We're not going to see any flux or any impact from a foreclosure market that's going to move the needle too much on this. We might see some, but I don't think it's going to move the needle too much. Here's the other part you want to look at. This was an article from Forbes, I believe. Was it Forbes? Where is it? Yeah, Forbes. This was back this time last year. So the housing shortage is worse than ever and will take a decade of record construction to fix. So a year ago, we were at a shortage that was worse than ever. Right now, based on the number I just showed you with our inventory, it's not worse than ever, but it's pretty darn low, right? But here's why it's going to take a decade to fix. Because if we look at the new home building starts, right here at the peak, this was where the crash started, right? This was 2006, where we had all these houses, and then 2007, 2008, boom, 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 boom. And we know a lot of people got wrecked during this. They got totally destroyed. And a lot of those people that got hurt the most were the new home builders, the people that were responsible for producing property or producing housing. And so they were hurt. So a lot of them just, were licking their wounds and went off to learn something else. And those that stuck around, it took a long time for those wounds to heal. And the memory is really strong. So it took a long time for them to catch up and start building and building and building. And even here in 2022, and we've had just this little drop here just recently, but even here at the peak of 2022, we were not even at the new building home starts that we had in 2006. So why is that? These are the new home building starts, and right here in May, it totally plummeted. Why did this happen? Builders said, whoa, stop, we can't build anymore. So we know that the supply is going to continue to be suppressed, but here's why. We have the price of inputs of residential construction are skyrocketing between labor and between the supplies. It's more expensive to build a house than it's ever been. And builders aren't going to build houses if it costs them more to build than they can to sell. So they're pulling back, they're slowing down. And so when you have the supply already suppressed, where we had up here, the inventory already suppressed, the supply already suppressed, with the population growing, and with the biggest chunk of this population, this demand growing at aging at a point where now they actually need housing, probably not a crash coming. Now, the big variable, what I point out, would be the interest rates, right? Would be the housing supply, or excuse me, the affordability. But people are still buying houses. The first-time home buyers are getting crushed. They're getting hurt. But there's a lot of money in the system still, and people are still buying houses. And so if they weren't, we would see a drop in prices. And we just saw a new record high for June, $450,000. We just broke $400,000 for the first time ever in history in May. And we're $50,000 more here 30 days later. Really, really remarkable. We've never seen growth like that, all at the time when it's supposed to be declining. Now, you might be hearing prices are dropping. You're going to hear that a lot. But here's another way that they're lying to you. It's not the actual value of the houses that's dropping. It's the seller's expectations are dropping. So if I'm going to put my house on the market today, and I know my neighbor sold their house for $550,000. Well, I'm in a hot market. Mine must be worth $600,000, right? So I'm going to go put my house on the market for $600,000. And then after a few weeks, I don't have an offer. I'm going to start dropping that price. So I didn't sell it for $600,000, but I probably sold it for $560,000, $570,000, which is still $10,000, $20,000 more than my neighbor. So did the price really drop? No, just the seller's expectations dropped. But the housing price actually continued to go up. Now, I'm not saying it's going to go up forever. I'm just saying that's what's happening right now. But the headlines and the statistics, particularly the percentages, where they're talking about percentages in decrease or percentages in increase, be really, really careful with those percentages. All right, so let me look at, there's that. Oh, and then the other part, go. The inflation numbers. Let me come back over here, and I think I got this. So our inflation numbers can be really misleading as well. And I gave a big, giant presentation on this at the same time. If we go back to 2020, August of 2020, when Jerome Powell said the central bank will be more inclined to allow inflation to run higher than the standard 2% target before hiking interest rates. That should have been a clue to all of us. And none of us really recognized it as that. Plus, we were all very much distracted at this time in August of 2020. We were watching a very divisive election. We were paying attention to social injustice, and we're still dealing with a crazy pandemic. And so those are the three stories that really dominated the headlines, but this stuff was happening underneath, and we just paid it no mind. And then here we are just in May of 2022 at 8.16, and as of this morning, it was 9.1%. So inflation. So what they're saying right now is, if I had $100 in the bank 1 year ago, and I didn't touch my money, I didn't do anything, I would still have my bank account balance would still show $100 today, but per the year over year inflation, I could only buy $92 worth of stuff. $92 worth of stuff. I lost $8 in my purchasing power of my bank account, even though I still had $100 there. So that's how the inflation is working. And so we want to look at, is it really just 8%? Did it really drop to 9%? Well, I have this kind of thing that I use. It's called the Subway Index, the Subway $5 foot long index. So we don't really see this commercial anymore, do we? No, not really. We don't see it at all. So remember, we could get a $5 foot long sandwich for $5. Then October 1st of 2021, that sandwich was $7.29. Now, that's not a 91% increase. That's a 45% increase. Then we come over here to January of earlier this year. That's now $8.99 for the $5 foot long. So now 79%. So the impact to your purchasing power of that $100 you had in your bank account, is it really just worth the $91 as of today's numbers? Or is it worth, say, $20, $21? Because we're more inclined to be trying to eat every day, right? And if you don't like Subway, that's just a Subway example. Let's look at something else that we all use every day. So inflation continues to rise and gas prices are up nearly 50%. So let's make it a nice, easy number. It's 50%. So your $100 now, if you got to get to work, you got to go places. Now that $100 in your bank account from a year ago is now only worth $50. It's cut in half. So this is really important. And there was this article that came out about the same time. This was in September of 2020. This is Ray Dalio, and this was on Market Watch. It's a really long article. You can go look it up. But the headline of this was, "The world is going to change in shocking ways in the next 5 years." And this was 2 years ago. And here was one of the final quotes. And I grabbed this quote and put this here. It says, "Worry as much about the value of your money as you worry about the value of your investments." This is from one of the richest men in the world, who runs one of the biggest hedge funds in the world. Worry as much about the value of your money as you worry about the value of your investments. And so what he's saying is, you had that $100, but now it takes you, it only buys you $50 worth of gas because the prices have doubled. If you didn't have your money invested in something that at least got you 50%, you lost money. So that's what he's saying here. And this is what we want to really pay attention to moving forward. And when you're looking at the prices of real estate, you're looking at the affordability, and you're looking at, we went up to 5.25% or 6%, wherever it may be right now. I'm like, oh my gosh, it's so high. Well, historically, first, that's really, really low. Second is, you've got your eye focused on the wrong number, because inflation is reaching into your bank account and grabbing the value of your spending power. It's grabbing your money, and you don't even know it, because your bank account still says $100, but only buys $50 worth of stuff, right? So understand inflation. It destroys the value of your cash savings, your stocks, your bonds, your cash, your equity, and thankfully, the value of your debt. So if inflation is robbing the purchasing power of your money, would you rather have it? It's an equal opportunity destroyer, by the way. Would you rather have it destroy the value of your money or the value of somebody else's money? Somebody else's money, right? Let them go destroy the other person. Leave mine alone. Well, the way that you can do that and put yourself on the winning side of this terrible situation that the economy is in right now, that this country is in right now, is borrowing money to buy um, hedged, inflation hedged assets, inflation in producing assets. Excuse me, income producing assets. That's all hedged by inflation. I got my sequence of my words out there wrong. But so here's what I mean by that. If we went down to, I'll skip over some of this stuff, right? So as I gave this presentation last weekend, our CPI index was 8.6. Today's 9.1, so this will even be even worse. But the wages increased by 5.4%, and the current administration is bragging about this. Look how much we increased the wages. But per the CPI index, we're at negative 3.2%. So those that got their 5.4% increase, per the CPI index, they lost net 3.2%. But if we're going to look at our $5 footlong index, or we're going to look at our gasoline bill, we lost a whole lot more than that. But housing went up 14.8%, which gave you a 6.2% increase based on the inflation. And rents went up 15%, 6.4% increase. So if you are an employee and you don't own real estate, or if you are on a fixed income and you don't own real estate, you got totally screwed. And you're likely to continue being screwed unless you get some real estate. Now, we could buy gold, right? People all think that a hedge against inflation is either real estate or gold. That's kind of the time-honored wisdom. But let's look at that, if that's our option, if that's what we're thinking. So here's the U.S. National Home Price Index in U.S. dollars and gold. So traditionally, back from 1975, where I caught this chart, pretty much they go neck and neck. The blue line is our housing index. The red line is our gold index. But right here, around 2004, 2005, the two started to separate. So as inflation continued to go up, so did our housing values continue to go up. Certainly we had a little bit of a dip here, but this little dip right here never dropped below the inflation rate. So the inflation rate was a straight line right under here. So even though we had this nice little climb, it never dropped, and then it continued to go up. But gold didn't fare as well. And why is that? Do you have any idea? Well, at the same time, when we were concerned with who was going to win, President Trump or Joe Biden, and we were concerned with racial injustice, and we were concerned with the pandemic and masks and social distancing, this little piece of information came out that really nobody even noticed. So JP Morgan pays the largest penalty, over $920 million, and admits wrongdoing in market manipulation case. JP Morgan, our friend, a lot of you probably have a banking account at Chase. They were manipulating the price of gold. They were manipulating the price so they could purchase more and get more at a cheaper price. So that's why you see the separation, and they got busted. And none of us even heard about it because we were watching other things on the news. And the news was talking about other things, so we really didn't have a choice. So what is our choice then? The only thing that's standing the test of time is going to be real estate. And I guess maybe that's a big clue as to why Bill Gates is buying up all the farmland and Bezos is doing something similar. Commodities, food, shelter, water, air. I guess if they could buy the air, they'd do that too. But all the basic human needs that we're going to spend our money on regardless, those aren't luxuries, those are necessities. So in a time of rapid inflation like this, if what we're going through, you want to be owning the necessities. And housing is the one that's most accessible to you and I, the average person. So is this a good time to be in real estate? Potentially, it's critical that you are in real estate. Critical. Okay. So I'd love to hear your thoughts about that. If you got any questions, please go ahead and share with me. And I want to show with you with, let's see what we got here. I got all kinds of weird stuff coming up here. I'll go through that in a second. Okay. Next, one more thing I want to share with you. I believe I covered that. Good time to be in real estate. Okay. So the deals. So right here in our own office over the last 2 weeks or so, notice a little shift in the attitude and the conversations we're having with sellers. Not a big one, but a little one. And what we'll find is when prices start to drop a little bit, and the market starts to soften, typically the sellers are going to be the last ones on board. They're going to be in denial. They're going to think their house is worth $1 billion, and they're going to try it until the very end to get that price. I think we're getting a little bit of help from the media that might be intimidating you or scaring you or manipulating the masses. And I think it's hitting the sellers also at the same time, because we're seeing a little bit of a softening. Because right now, as we're in this transition, typically the sellers are still in denial, because we're right at the tip of this transition, if we are in one. Certainly, there's a few indicators that point that we very well could be. But typically the sellers aren't even close to being on board yet. They're not even gonna be buying into this prices dropping for another 6 months, historically speaking. But we're noticing it already. The second thing that, so that was in the last couple of weeks. Here's what happened in the last 24 hours. I took some calls for some of our REI ACE clients. I was following up with some of their leads for them. And there was one seller who just a week ago, 10 days ago, said absolutely no to seller financing. And I had another one, very much like, oh, it's a good idea, but I don't think so. I'm just going to still try and get my price. So I had one that was adamantly against it, one that was kind of against it. So here's what we did this week, where we actually turned both of these people who were against seller financing into seller finance deals for my clients. When I was a real estate agent, this was something I would do when I had a listing. And this all happened in 2007, 2008, because I've been through one of these downturns before. So I know how the sellers think, and I know how to kind of manage this and what needs to happen. And the way that I would counsel them back then is, let's see, this might be a little bit easier to follow along with the diagram. So let me just see if I can conjure up some art skills to articulate this clearly for you. All right. Okay, so here's the house, right? And here's the house's value. Say it's $500,000. There's the value. And the market is supporting a $500,000. So the market's been doing this, right? The market's doing this, and right about here, it peaks, and the house is worth $500,000. Now, the market starts to adjust a little bit, and maybe it comes down, right? And it starts to come down. And right about here, this seller is thinking, uh-oh, I haven't sold my house yet for $500,000. So the agent comes and says, we should lower the price. So they'll drop it down to say $480,000. And then the market continues to drop. And they're like, oops, I haven't sold my house, so maybe we should drop it to $460,000. How the market continues to drop, and oops, $450,000. So what happens here is the seller is chasing the market down, but they're behind the market. So what happens over time is they're having to ask less and less and less and less for their house. So as an agent, what I would have recommended, or what I did recommend, was, you know what? If the market is doing this, we got to get ahead of it. We got to drop down here really quickly. And so if we're at this point, I was like, we need to drop this down to $390,000 so we can wait for the market to come down and reach us. But the market won't reach us. There's still the demand down here that still want to buy houses. And if they're looking at all these houses up here at this price, and all of a sudden a house comes on the market at this price, then they all go and they all start bidding for this house. And then they do a little bidding more on that, and this house comes up and then maybe it sells for $430,000, $440,000. See how that works? So this is what I'm explaining to my sellers. Well, they don't like our cash price. I'm like, okay, well, Mr. Seller, Mrs. Seller, I'm probably not the buyer for you. And that's okay. I don't expect to buy them all. But here's what I recommend is, if you are going to put your house on the market, be careful that you don't chase the market down and follow it down incrementally. And you want to jump out in front of it and down here so you can get these people to bid it, and then it's going to rise up, and it'll land at market value wherever that is, because we don't know exactly where that is. But all we can do is base it on, we want to underprice it so it causes the people that are in the market shopping for a house, get them to bid on it and get it, and they will bid it up to actual market value. So we want to get ahead of it. So I was like, Mr. Seller, okay, it's okay. I'm not the buyer for you. Go ahead and but this is what I recommend is you get ahead of this thing, or else you're going to be chasing this thing down potentially for a very long time, and you're going to get a lot less money than if you would have just done your massive price reduction like right now. And then, so I left them with that. And I did that for 2 people last week. And then they came back this week and they said, we've gone through a few price reductions already, and I think you're right. and we really want to get maximum dollar for our property. So can you explain to me how that seller financing thing works again? So I think there's a huge opportunity to be the good guy. You get to be the good guy, the good girl, and say, you know what, Mr. Seller, it's okay. I'm not going to try and grind you on your price anymore. I'm not trying to get it at a deep discount. I got plenty of opportunity over here. I don't expect to buy them all. But if you're going to go ahead and go with the agent or continue with your agent, this is what I recommend you do. Get ahead of the market and do an aggressive drop and just kind of take it away from them. And that's exactly what we did. And it worked 2 times in a row. Now, I don't know if it's going to work again, but it was kind of a unique situation, a rare situation where it did work 2 times in a row in this particular market environment. Okay, so keep that. Make the market the bad guy. I'm sorry, Mr. Seller. I think your house is well worth that $500,000. It's a beautiful house, but the house is only worth what the market is willing to pay for it. And right now the market is saying, ain't worth it. The rising rates are causing people to, it's causing their house to become unaffordable to them. So they might like it. They may be willing to pay for it, but the bank is not allowing them to. So we can only sell our house for the people that are in the market that want it and have the ability to pay for it. So if you want to get ahead of that, go get ahead of that. If you change your mind and you want to get top dollar, and I'll give the $500,000 right now, if you're willing to take some money right now and the rest later, those are kind of your 2 options. And you leave them with that, and now they got a very, very basic decision to make. Alrighty. So if you got any questions, let me know. What do we got here? Greetings. Good to see you. Chris and Letitia. I don't know what all these weird little, I'm getting John 3:16. Did I say something that was blasphemous? Did I, who knows? Okay. I've been known to, but it wasn't my intention. What's this say? Let's see. Yeah, greed stops people from looking at things objectively. 100%. You know, they're used to, typically our real estate market is 7 to 8 year cycles. We're like in a 15, 16 year cycle. And people are really accustomed to watching their houses, accustomed to seeing their houses appreciate, and all of a sudden it stopped. And all of a sudden, like, whoa, what happened, right? So they start questioning it, for sure. Let's see, should we buy to rent? This is a good question. I got to be really careful, because when you use the word should, right, that's a big loaded question. I am not slowing down. I feel I should, and I am. I see and we're having this conversation with a bunch of our cash flow savvy clients right now, where we go out and we find income property, we fix them up, we put a tenant in place, we coordinate the property manager, we do that for busy professionals. So that's one of the business we have. But the name of our company is Cash Flow Savvy. And right now with the rising interest rates, the cash flow is getting squeezed a little bit. And the properties that we're used to selling and the assets and the portfolios that we're used to building the newer purchases right now aren't cash flowing as much as they were. And some of them are like just kind of break even. But I would encourage everybody, when you're looking at the inflation data that we just looked at first, and the second thing, the supply and demand, the population, is the number of people to soak up all the houses that are available. We know we're probably not going to get this giant influx of foreclosures. We know that the new home builders have pulled back because they're terrified. So the supply is still going to stay low. It's going to stay low, but the demand is already here. Over the next 24 months, we're going to have more demand, more people looking for housing than ever before in the history of this country. And then we got Gen Z right behind them. So I'd say the next 10, 20 years, I think buying income property is a really, really safe bet. So there's my answer. Okay. Let's see. Is building to rent a good option? Is what Lance is asking me. If you can build it cheap enough, Lance, like it all depends. Like what are you going to build? If you're going to build a multifamily property where you have multiple units and you can take the income from a bunch of units to pay for the costs, then yeah, it may be, right? But it's all going to depend on how cheaply you can, or affordably or inexpensively, build the property to rent out. But yeah, that's how I'm saying. That's how I see it. So thanks for being here. I really appreciate you. I just wanted to share that information with you because there's a lot of information going around that could be causing some confusion, could be causing you to panic a little bit, could be causing you to be scared a little bit. I would say if you have, here's two things. If you have been successful investing in real estate, even if you've just done a couple deals every year over the last 3-4 years, I think you are positioned to be extremely successful over the next couple years. Because I think if the interest rates continue, if sellers start to panic a little bit, then that could be a little bit of, there could be some opportunity in there. And so I think might be finding a little less resistance as far as the negotiating goes with your sellers, like we have just in the last couple of weeks. So there's one thing. The second thing is when you're evaluating property, if you take the basic vanilla formula of, that nice, quick and dirty math of formulating what your wholesale price is going to be. You got your value, multiply that by 70%, you subtract your repairs, and then you subtract your profit, and then you're going to wholesale that to a fix and flipper in most cases. Or if you're going to fix and flip it yourself, these are two things you need to be, or what you need to be concerned about, is that formula was based off of the comparable data, the comparable sales of today. Now, if you're going to go fix and flip that property, or if you're going to sell it to a fix and flipper, and that's going to take them 2, 3, 4 months to complete that rehab, what is the value of that property going to be 3-4 months from now? What is going to be we know the demand is going to be there, but will that demand have the ability to purchase at that price down the road? So you want to be really, really careful when you're evaluating your properties and you're evaluating your deals, and you're probably going to start wanting to be a little bit more conservative. And that data that I just shared with you right there, or that line of thinking, you could share that with your sellers. Yeah, Miss Seller, I understand that's what the house is worth today, but we all see what the market is doing, that darn old market. It keeps getting in the way of our progress, but it is what it is, and it's doing what it's doing. I'm going to have to come in and fix this house and put some money into it, put some time into it to get it to the full market value. And that's going to take me 3-4 months. And, it's not looking good what the market is going to look like in 3 or 4 months. So that's why the adjustment now. So make the market the bad guy, not your opinion. You're just laying out the facts. And with all the media, all the news out there, they're seeing all the same things you're seeing. Okay. So, and then what was the next thing? Oh yeah, no, I think this is a great time. First thing, if you've been moderately successful or if you've been struggling, I think easier times are coming. The second thing is be really, really careful on how you comp out your properties, right? After how you evaluate and how you make your purchases, because what's a deal today in, you think you scored, if you have to do some rehab, it's going to take some time. In 3 months or so, that might not be the deal. So that's the two things I want you to really look at. And also, I think this is an amazing opportunity to really hone in your creative financing skills. Because if I'm here going to tell the seller that, you need to do a massive price drop to get out ahead of this market so you don't keep chasing it down and making less and less and less money. That's one option. Or, we could maximize your bottom line and get you your full price if you're willing to take some money now and the rest later. So which one do you want to do? Massive price drop, or do you want full price? Right? And it's going to be a great conversation, and I see that happening for the foreseeable future. And you better know how to structure those types of deals, because I think that's where the opportunity is. And if you can take those properties with seller financing, so you don't have to go to the banks, now you're owning income property. And then now we see what the rental demand is going on right now. It was at 24% year over year for a 2-bedroom. That's remarkable. That's like double what the sales price is. And traditionally, it's reversed. But now here we are. Boom. Okay. So let's see. You are welcome, Chris. Good to see you, buddy. What's this one? As a newbie, where would you get started? The same place a seasoned veteran would get started. We're looking for motivated sellers. And so how do we find motivated sellers, or what causes a seller to be motivated? Typically, life's happening to them. It's death, it's disease, it's drug, it's delinquency, it's job loss, it's all kinds of things. They're frustrated. They may become a bad landlord or had a bad landlord experience, or their tenants messed up their property. All these types of things are happening to people. And with the economy doing what it's doing, you got the stock market crashing, people are hurting there. We got people losing their jobs, that got people hurting there. And so a lot of these people are going to be financially stressed or distressed. and they're going to be looking for some sort of financial relief. And a lot of these people where life is happening to them right now, unfortunately, they own property, and they're going to be turning to their property for financial relief, and they're going to want it fast. So we need to start reaching out to people that are having these problems. So whether you're going to knock on doors of pre-foreclosures, or you're going to start cold calling landlords that got vacant properties and just went through evictions, or you're going to send direct mail, or you're going to run pay-per-click ads, it's all the exact same thing. This is a people business. Every piece of real estate we buy or sell is going to be from or to another person. So we need to start talking to people and say, hey, how can I help you? Right? People will right now that are, freaking out a little bit, they will exchange equity for peace of mind. And that's what we do. We go ahead, we're going to give them some peace of mind in exchange for some of that equity. Okay, so mighty savage. Hopefully that helps a little bit, but I wouldn't give advice to a newbie any differently than I probably would a seasoned veteran. Okay. You're welcome. So what do you think developers should be doing now? Should they be on the side? Okay, so here's a good question. Let's ask this one. Interesting that this question, what's the newbie, where should the newbie start? And then this is kind of where should the seasoned veteran start, came from the same person, but it's okay. So what do you think developers should be doing now? Should they be on the sideline for now? What is the sign that they should be getting back into the game? I think for a developer is looking at what you're always looking at. Where are the opportunities where you can build for cheap enough to where you can sell for high enough to make a profit? I got a buddy in Los Angeles that only does luxury rehabs. And so he's like, this is the only place I can really make it work right now. I'm sure my materials are higher. My money costs are going to be higher, but I'm selling to a clientele that can afford it. And I'm selling to a clientele that's willing to pay it. So that's one way. I don't dabble too much in multifamily, certainly not in the context of developing. So I don't know what those would cost and what that cost analysis is, but that's all you're looking for. If you're a developer, if you're a builder, if you can build it low enough to where you can sell it high enough, then yeah, maybe you get in the game. But we saw what the builder starts are doing, right? That was right over here. So the best people the experts in the business here, where to go? Right there. So this represents the building starts right here in May. They put the brakes on hardcore. They said, nope, we're gonna stop. We're gonna pause this for a second because we're not quite sure how we're gonna make money until the supply chain issue eases, or the money issue for the buyers eases. Then we're gonna pause. And so they're pausing. So if you can figure it out, then by all means, there's a lot of demand out there, and you can make a killing. But you got to figure out how to build for cheaper than what you can sell. All right, y'all. Oh gosh, we've been here for a long time, 52 minutes. I always feel like I'm not going to have enough to share to fill up a whole episode, and here we are for 52 minutes. So thank you. That's it. If you found this valuable, who else do you know that might? There's a good chance that you do know someone else who would. And when their name comes to mind, please share it with them, and have them click the subscribe button when they get here. And if you haven't clicked the subscribe button, please do that. Hit the like button. It's all for that YouTube algorithm. We gotta placate to the YouTube algorithm all the time, so they'll show this information, show our videos to other people. So go ahead and do that. Alrighty. So God loves you, so do I. Health, peace, blessings, and success to you. I'm Matt Terrio.